which is known as regressivity. Essentially, New York has a regressive property tax system, and the low valuations mask that because, if I own a $200,000 home and they're only capturing $85,000 of my value, I'm thinking, hey, I'm getting a good deal. What I don't know is that the person who owns a $2 million home, they're only capturing, or 200,000 of that. So, one might be getting 37% of their value captured, and the higher end property will be getting about 13%, and that skews the tax bills for the entire city, that valuation process.
Right. Jason, this is one of those stories that I encourage everyone to read online because there's an interactive element to it, and there are some amazing visuals that show on a chart how much a condo is worth and the portion of that they're paying in property taxes per year. And it's pretty mind-boggling to see, and you really have to look at it to just understand the magnitude of it. So what does New York City, what do New York State, what do they say about this? Because they are leaving money on the table.
Yeah, so we were not granted any interviews with the city despite months of trying. What do they do about it, is kind of the big question. And the problem here is that this issue has been going on for so long that the market itself, the real estate market itself, has incorporated these skewed taxes into actual values. They've capitalized them. So untangling this is going to be a real problem. And that's one reason why it hasn't been fixed in 30 years. There have been 3 mayoral efforts to try to fix the property tax system in New York. So people are well aware that there's, underlying problems. But, in order to fix it, you're talking about a massive wealth transfer. People who own really high-end condos and co-ops will be taxed at much higher rates, which could impact the value of their property. And that, in a nutshell, is why it's so hard to fix.
You can't help but feel, I have to say, we went through recently like a tax reassessment, and everybody was like, well, wait, what is your property? And I feel like as transparency, or if this data was all put out there and everybody, certainly those who are benefiting might not so want that stuff put out there. But if you are being penalized, you're going to be like, well, wait a minute, this isn't fair.
Yeah, I think, first of all, New York is not alone in these issues.
Good to know.
We published a story earlier this year looking at this at a nationwide level, and we found that this problem of regressivity is inherent in jurisdictions across the country. New York is huge, and it is particularly bad, and kind of as New York goes, so does the rest of the country. So we wanted to drill down into New York. But, the thing that you're touching on, the transparency piece, is key.
Yeah.
If people can't see clearly, it's very hard to understand what's going on.
What is the relationship between landlords and this policy? Because I think to myself, okay, well, New York City is a place where a lot of people rent, and I wonder to what extent landlords have had favorable tax advantages.
Well, what we found is that actually the effective tax rate, which is really just the property tax bill divided by the value, the market price of the property, we found that rental properties actually pay a higher effective tax rate than condos, because that was what we studied, but cooperatives are valued the same way. And what that means is they're in the same, what they call tax class. So it's a matter of how is the distribution of the property tax burden, how is it distributed? And within a tax class, everyone should be paying the same effective tax rate. And what we found is that condominiums pay much lower effective tax rates than rentals. And what that means is, to the extent that landlords pass the cost of taxes on to their tenants, rents are higher than they would be potentially if those taxes were lower. Of course, landlords might pocket a lot of that money as well. So it's a very complex problem. But what it means is a lot of the burden is being shifted onto rental properties.
Yeah, that's interesting. It sounds like nothing's going to change. Just got about 30 seconds here, right? At this point?
Mm-hmm. I think it's going to be very, very difficult. The political optics of it are very bad, and sort of the lesson, we're writing for a national audience, and the lesson is don't let it get this bad.
Nothing gets people going though like property taxes, right?
Any
in terms of assessment.
right?
You mean taxes in general? Jason, thank you. It is an in-depth story, and as Tim said, check out it online because there is a lot of interactive components to it and a lot of information in detail.
Yeah, you can see Jason's story. It's available at Bloomberg and at bloomberg.com/businessweek. You can also get to it on the Bloomberg terminal. All you got to do is type in NI Big Take or just N Big Take.
Jason Grotto, he's senior investigative reporter at Bloomberg News, joining us on the phone from Chicago. All right, we're holding on to that rally. We're still staying near our highs of the session, so we're up 1.7% on both the S&P and the NASDAQ. The Dow up about 1.6%. We know technology certainly at play. We heard that from Dave. The big banks, kind of a mixed picture, so we'll continue to track the markets. But speaking of those big banks, we're going to check in with Sonali Bosick.
Yeah, she's Wall Street reporter for Bloomberg News. She's been in here since 4 a.m., Carol, doing all things earnings.
And she has so much energy. She's still going. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading on this Thursday, October 14th. Best level of the day right now for the Dow, the S&P, and NASDAQ, also on track for its best day since March. Better than estimated corporate earnings and economic data, outweighing fears that inflation pressures and supply chain snarls could crimp growth. We've got right now the S&P advancing 73 points, up by 1.7%. The Dow higher by 529, up 1.5%. NASDAQ up 251, up 1.7%. 10-year yield, 1.51%. Spot gold up 0.3, up $5.90 the ounce to $17.98. West Texas Intermediate crude up 1.2%. 81.41 for a barrel of West Texas Intermediate crude. Lots of earnings today. Morgan Stanley's investment bankers scored their best quarter ever, boosted by a torrid pace of deal making. Morgan Stanley shares right now are up by 2.4%. As for the market backdrop and what's ahead, Bloomberg Radio caught up with Morgan Stanley Chairman and CEO James Gorman this morning.
We're seeing sharper movements in the market by the day. Some of the sort of earlier bubbles around SPACs have clearly gone off the boil a little bit. There's more geopolitical tension between the US, China, talk of Taiwan, etc. So I think you've just got to be, our job is to be mindful and to, on the one hand, have your foot on the accelerator, but the other, constantly be looking for where the big potholes are.
And coming up, we will have more on big bank earnings with our Sonali Basak right here on Bloomberg Business Week. Morgan Stanley shares up 2.5% among some of the other banks out this morning. Citigroup up 0.9%. Wells Fargo, though, down 1.1%. Bank of America up 3.9%. Goldman tomorrow up now by 1%. Recapping S&P up 73. I'm Charlie Pellet, and that is our Bloomberg Business Flash.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
She's had a few cups of coffee. How many cups of coffee have you had?
I've had a 5-hour energy, and I've had 2 cups of coffee today.
How many cups of coffee does a 5-hour energy count as?
I don't know, but the energy only lasted 4 hours for me.
Oh,
So,
okay.
All right, well, we're going to kind of like try and kick up the adrenaline right now. Let's talk about the bank earnings bonanza. So we had B of A, Wells Fargo. We're going to hear from Brian Moynihan when David Weston catches up with him. Wells Fargo, Morgan Stanley. You talk with James Gorman over at Morgan Stanley. Citigroup all reporting profits in the third quarter. I mean, everything beat, right? The analyst expectations.
the investment banking revenues almost everywhere were just through the roof at every bank that mattered for it. So, Wells Fargo is a little smaller in investment banking. Wells Fargo has challenges of its own, and, you're seeing that reflected in the stock today. But, there are challenges still with the consumer. And people are wondering when the next shoe is going to drop. There are clearly competitive forces, but it's not so bad. And the outlook is so rosy. I felt like I woke up today and it was turning a page because I came in with expectations, still tough.
Right.
Bar is high for everybody. But the fact that everyone thinks that things are going to get better to the point that James Gorman is saying there should be a rate hike in the first quarter of next year, it says a lot.
So
that's huge.
It is.
Sorry.
No, go ahead.
Sitting with it. Go ahead. No.
Okay, I'm just wondering if there's a disconnect between the rhetoric that we're hearing with people who are concerned about what's happening in the market right now and who are concerned about what's happening in the economy and what we heard from executives of banks this week.
The thing that's funny about bank earnings and executives and the markets is that things can change overnight, always. Always, always, always. But, right, and Morgan Stanley is the firm that lost a lot of money just months ago on Archegos as well. But the thing is, they ended up fine. These companies are generally healthy. And they, I'll take a page again from James Gorman, who said markets go up, markets go down. We're not expecting a crisis. So, a correction here, a correction there really still makes it easy to still trade on volatility and buy the dip, honestly.
It's interesting about the interest rates, though. I mean, banks benefit, right, by higher rates.
Exactly. So, I did tweet that, and I did get some responses saying, oh, a banker says he wants higher interest rates?
No,
Shocker.
really? Wait, what?
But, on the other hand, it's true. They benefit from higher interest rates. But at the same time, there is a delicate balance because if rates go too high or if rates start to rise, then does it start to dampen demand for certain products? Mortgages is the big one we're watching for the big consumer banks. It's something that, Jamie Dimon in prior quarters has warned that it could start to slow the demand once we see higher rates. It could also start to even lessen even more that debt boom that we're seeing. And if equity valuations start to go down, you start to wonder if the IPO market is going to be as gangbusters as it is right now.
You also talked about inflation. And we have a little piece of sound. Can we play a little bit? Let's hear from James Gorman, of course, the CEO of Morgan Stanley, when he talked about inflation, transitory or not. Check it out.
I'm not a buyer of this story that it's all transitory, the inflation story. It's not transitory. I mean, wage inflation is real, and the supply chain interruptions, and you were talking about some of the natural gas and other things, have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now.
That was James Gorman, CEO of Morgan Stanley, earlier today on Bloomberg, talking to Shonali Basak and our colleague. Shonali, so what did you make of what he said about the idea of wage growth specifically? Because that's something we hear over and over again. You can't, lower someone's wages as easily as you can not give them a bonus next time.
Yeah, some of the banks said to expect higher expenses in the future. Jamie Dimon at Jamie Dimon at JP Morgan.
You have been up since like 2 a.m.
It's all the same to me at this point. No, I'm kidding. But Jamie Dimon did say that to expect expenses to be higher later, they have to pay, they have to be competitive. We actually saw headcount, by the way, decline at Bank of America and at Wells Fargo.
Which is interesting.
Very interesting.
Well, that seems to
where? Do we know where? Sorry.
Go ahead.
I don't know in all the different units. I'm hoping that David Weston will ask him a little bit more later about color behind that. Remember, Bank of America does have wage pressure almost at every level because they also have committed to raising minimum wages before many others have, not just for themselves, but also for their suppliers. So let's see how that all shakes out at the end. They're investing in digital as well. They have to. The fintech competitors are very, very significant.
Right.
Bank of America had record digital usage. So it is a really interesting time for these firms because you're seeing them grapple with pretty high expenses still, margin pressures ahead of themselves, and moderating revenue. Remember, many of these firms had lower revenue than the prior quarter.
Well, let's talk more about those expenses because that was certainly what has some investors concerned about Wells Fargo. Shares of Wells Fargo are down 2% right now. The company did beat on the top line and the bottom line, but operating expenses, even though they declined, they still were higher than analysts wanted to see.
Yeah, and that's the thing. Expense reduction is such an undertold part of all of the firm's stories. The more that you can get a hand, that's the one thing you can control. You can't always control the markets or how much you make from them, but you can control what you're spending. Wells Fargo has some levers eventually, real estate costs as well as headcount reductions. But, Charlie Scharf, he's a little further into his tenure now.
Right.
His grace period is, starting to wane a little bit, but you have seen their stock outperform, for example, Citigroup, which these two banks have regulatory issues. And at the end of the day, those are going to be expensive for them.
Right. There's overhang. There's a cost to that overhang. We're not done yet, right? We've got, Goldman?
We have Goldman Sachs tomorrow. I can't wait. They have been making so much money in investment banking. Goldman Sachs is the primary.
Can I just say the funny thing is she really can't wait because she really does enjoy this. But
does
anyway.
that mean another 4 a.m. office?
It means another 4 a.m. office. I should be talking to David Solomon tomorrow. Would like a lot of color from the man on what he expects. Does he have, his deputy, John Waldron, his top deputy, was speaking this week and said, he was really the first to say very strongly this week that he was worried about inflation. The question is, what does that translate to in terms of business?
Right.
Does it mean higher rates, and how does that start to impact these businesses?
It is interesting because these were the big bank CEOs that were just sitting before President Biden. What was it, a week ago?
Yeah.
Saying that the debt ceiling was going to sink the entire economy.
Right.
Yes.
Exactly. And here they are. It does feel like there's somewhat of a similar tone when it comes to inflation concerns, rising wages. It does feel that way.
Yes. And at the end of the day, the other thing that people don't talk about enough, the rising rates could impact what the borrowing looks like for things like private equity firms and buyouts. So that's, again, corporate activity. We're still worried about the consumer, not corporations. But if higher rates could impact something that's been a big fee engine for them.
Hey, what are you looking for from Goldman Sachs tomorrow? We talked a lot about consumer banking, especially in the context of JP Morgan earlier this week. We heard comments from Jamie Dimon.
I still don't think of it as a bank.
Goldman Sachs?
Sorry, no.
Marcus.
Well, there were so many new products there.
Yeah.
Well, Shonali, you've done a lot of reporting on the acquisitions recently that Goldman Sachs has made in order to try to get more into the consumer division.
JP Morgan and Goldman Sachs have been buying assets left and right, and we can't even keep track. They're firms we've never heard of sometimes, from Nutmeg to Green Sky, and not the acquisitions 5 years ago that you thought they would be making today. But Green Sky gives Goldman Sachs a bigger presence in Atlanta, thousands of more in headcount. With that headcount comes millions more in customers.
Right.
And so, how do they've also launched new products at Marcus, right? Investing products, and we'll see what that all amounts to. We keep on asking them, but what is Goldman Sachs in 5 years? They didn't buy two major firms like Morgan Stanley did.
Right.
But they are doing these tuck-ons, and, their stock is, their market cap is trailing Morgan Stanley.
Well, and I
right
think
now.
about the Citi story, right? The cover of Business Week, Jenny Serane's story, but this whole idea of, wealth management and really trying to make some inroads in that after they lost, or got rid of Smith Barney, way back when. But it's just interesting. I feel like wealth management is a little bit more traditional.
It is a very, very
Right?
traditional business. But, what is it? It's a lot of boring businesses inside of it. It's a lot of tax management.
Yeah.
But, it's something also, remember, Goldman Sachs really does bank the wealthiest of the wealthy in the world. And, we've spoken to their heads of wealth management, and they have said they're expanding abroad as well. So it's not just in the U.S. And they're expanding into people who are not as wealthy as they used to bank before.
Okay, I know you're going to get a chance to speak with David Solomon tomorrow, but what do you think analysts are going to be asking about on the call before you get a chance to interview him?
Market share is number one. The other competitors were very impressive in terms of what they had posted. So where is Goldman in that story? In equities, in fixed income, and in investment banking, and then also levers on expense control. I mean, Goldman has been doing an extraordinary job relative to its peers. And so do they find any more levers to keep costs down?
All right, we do want to mention a red headline crossing the Bloomberg terminal, and this has to do with Moderna. The FDA advisors backing Moderna booster shot for ages 65 and up. So that mirrors what we've heard for Pfizer. Just taking a quick check on shares of Moderna in terms of reaction. Yep, stock shooting up about 4% on that news. So again, the FDA advisors backing Moderna booster shot for ages 65 and up. We mentioned earlier, Tim, that the FDA would be looking at both J&J and Moderna in terms of those booster shot. Final thoughts here?
Final thoughts.
Sonali? Not on Moderna, but on banks.
Things are pretty good. It's
Okay.
crazy. Like I didn't think they would be, but they are.
All right, listen, great analysis. I know you've been nonstop, and we're going to be looking forward to Goldman Sachs when it comes out and your instant analysis and the takeaway. We'll see if some of the trends continue, right? Especially, I would assume M&A will continue.
M&A will continue, at least for now, until the Biden administration has much more to say about that.
All right, looking forward to it. All right, thank you so much. Really appreciate it. Sonali Basak, she is our Bloomberg News Wall Street reporter, tracking all of those big banks and those results coming out on a day when we're seeing the markets rally big time. And Bank of America, really one of the standouts when it comes to the big banks. We're going to head over to Bloomberg Television, where our own David Weston, host of Balance of Power on Bloomberg Radio and Bloomberg TV, is catching up with the CEO of Bank of America. We're talking about Brian Moynihan.
Markets to close. I'm David Weston. For our television and radio audiences worldwide, I want to welcome now Bank of America Chairman and CEO Brian Moynihan for an exclusive conversation. Brian, thank you so much for spending time. You're having quite a day, I think it's fair to say. You had your earnings out. Pretty impressive. Let me ask you about recovery. There's a lot of talk about recovery right now. Is Bank of America fully back from pre-pandemic at this stage?
Well, thank you, David. It's good to see you again, and hope everyone is safe in their family. And we're back. In other words, the activity levels and what goes on day to day is bigger than it was before the pandemic. We could talk about the economy and how that affects us, but the actual company got about half the people at work every day, and we're building that up as we go. And we've got, we're doing our job for our customers and our clients, and our communities, and our shareholders, as you saw today, while we're doing that. But we're still partway to getting people back at work and normalizing. That's had a town hall today with hundreds of teammates in the audience, and it's feeling more normal, but we still got to keep pushing ahead.
But your business is fully back to the levels from pre-pandemic?
In terms of, production of credit cards this quarter, for example, we did 1 million new credit card customers with our discipline, and that's as much as we did in 19. And so if you think about the company, we were on an organic growth drive in 16, 17, 18, and then we hit the pandemic in 19, and then we hit the pandemic in early 20. What you've seen now is, you just imagine, just like the economy, that was on an upward trajectory. It dipped, and now it's right back on that trajectory. And so are our loans a little less than they were then? Sure, but year over year, the loans are basically flat. They've grown 2 quarters in a row and are building. And on the deposits, it's been 15% growth year over year, 12% growth, those types of numbers. So that's not the question. And then on investment banking fees and those things are at record levels, and core loans are starting to build, and that's all going to bode well for us.
So you mentioned credit cards. It brings up, to my mind at least, consumer spending. You have a vantage into an awful lot of consumer spending in the country. Where is consumer spending in the country? What does that tell us about the economy?
Well, to talk about that, first, to put the broad context around it, this year at Bank of America, we've already done about $2.78 trillion of money moved from consumer accounts into the economy by charging on a debit credit card, by writing a check, by taking cash out of the ATM and spending it, by moving money from P2P payments through Zelle, all those different ways they move money. And so that's grown. Over last year, it's grown by 20% plus. Well, you'd say, well, last year was still in a pandemic, but no. Last year, this quarter, we were growing at 20% plus over 19. So it's basically, if you look at it, it's grown at 20% plus over the highest levels before the pandemic, and it's growing. The month of October is up 13, 14% so far. And so the month of September was the biggest number during the year. So across that, almost $3 trillion of spending so far this year, and a record amount in the third quarter in our history, you're seeing that grow at double-digit rates. That is consistent with the 5% projection we have for this economy to grow this year and what the growth is seen in first half. And it's consistent with what we see next year, which is 5% plus growth in the U.S. economy.
Brian, how much vantage point do you have into the holiday season that's coming up? Terribly important for retailers in particular. There's some concern expressed about supply chains. Do you have any sense of the consumer spending going into the holidays?
Well, it'll be interesting because, yes, it's a big spending season, and that'll be in the year-over-year comparisons from 19 to 21, skipping what happened in 20. But the thing is the question is, do people have the money to spend? And the answer is yes. If you look in the checking account deposit customers in our consumer business and look in their accounts, people with like $2,000 to $5,000 average balance, which means households probably making $75,000 a year type of numbers, they are up 250% before the pandemic. They grew from the month of August to September by 2%, just not annualized, just growth. And they're up 50% year over year. And so they have more money to spend. Now the question is, can they get the goods in the country for them to buy? And I think, my guess it'll be a Christmas that has a little bit more on, here, we're going to get you this bike as soon as we can find it, or we're going to get you this toy as soon as we can find it, but here's a picture of it like we used to do when we were younger, or people are going to spend it on experiences. But the overall activity levels are very high, and they may be impacted by the supply chain, but it's not necessarily purchasing denied. It's purchasing that may be pushed out a little bit as the goods and services get in the country. We've got to get the supply chain straightened out. These ports have been an issue for many months now. It's good to see the attention getting on it. That will then ensure that the first half and second half of next year are better than they would otherwise been if the situation persisted. We got energy issues. We got to make sure the energy supply stays consistent. There's a lot of things in there, but the consumer is in a position to spend, and that's what will drive it. And I think they'll find some place to spend money.
Brian, it's a short step, I think, from supply chain problems, and you mentioned energy as well, to inflation. There's a lot of debate going on right now. How bad is it? How persistent is it? What do you see?
Well, a few months ago, I think you and I talked about the idea of transitory inflation and what that meant. And so what that means is that if the price goes from 100 to 115, it's the expectation next. And what you've seen change pretty dramatically is the expectation from that 100 and 115 is 5% more next year. It was 1 to 2% more. So not only the actual inflation of prices in the economy, which the argument by economists is those will be adjusted for and absorbed. The question really on the table now is the expectations are that they're going to continue. That's real inflation. That's going to, and that's why the Fed has sort of indicated they're going to start to taper and start to pull out the monetary accommodation. Think about the unemployment rate of 4.8. Normal would be not back to the 3% level, but more 4 to 4.5. Think about new claims for unemployment dropping. Think about all those things going on and worker shortages. All that will give the rise in wages, which are growing fast. All that's inflationary, and that's why the Fed is starting to indicate it's time for them to move, given that the core virus path is more assured. Now, could that be affected by shortages, which may cause changes in the economy? There's a lot of things that could affect it, but right now that inflation is clearly not temporary, and as people worry about, it's more permanent, and a way to conflate that is start to get to work on it.
Which leads us to the question of interest rates. You had an increase actually in your net interest income or net interest yield quarter over quarter, despite the fact we still have very low interest rates. Do you expect the Fed to raise, and if so, what does it do to your net interest income?
If there's a 100 basis point movement in rates on a parallel basis, so to make that more straightforward, if Fed funds rate goes to 1% and a 10-year Treasury goes to 2.6 or whatever it would be, we make about $7.25 billion more in that 12-month period. That's because our deposits, our checking deposits, our transaction deposits for business, are zero interest deposits. So out of the $2 trillion in deposits, a substantial part don't have any interest rate attached to them. And as the floor comes up, we make more money. But the reality is we got more improvement in NII this quarter, as we told people we would. We said as we grew loans, or as loans stabilized and started to grow, which we said in the first quarter, and frankly, people looked at us like we were a little crazy because we saw the stabilization. We said it was there in the second quarter, albeit in the second half of the second quarter. It's really, all that growth stayed with us, and we grew on top of that $16 billion from second to third quarter. That's what's caused our NII to grow, is more loans, more deposits, and positioning the huge liquidity that will stay with us because we're ending up with more core accounts for American consumers and businesses around the world.
Ryan, you also had quite a quarter when it comes to investment banking, both in terms of advisory fees, but also some of the trading that got done. What drove that trading? It was pretty extraordinary.
Well, David, Tom Montag, who's going to retire at the end of the year, has done a fantastic job for us. He's one of the things he's done, not only how he stewarded the business for the last decade plus, 12 years or more for us. He also brought in a lot of great people. So Matthew Coder on the corporate investment bank and has been hitting it well and driving that. And then Jimmy DeMar, who runs the trading business for us, done a good job. And so we're very happy with the business. It's amazing how much the investment banking business has been sustained because of all the activity, but also given sort of the restrictions on travel and stuff like that. It's pretty amazing. Shows the adaptability of the economic system. And so we feel very good about it. Matthew and the team, I think, had $2.1 billion plus investment banking fees, the second highest we've ever had. And Jimmy and the team, if you look at in our materials, you can see they're about 25% over their average third quarter or first three quarters of the year trading revenue. We're up year over year so far in trading revenue, and he's done a great job there too.
For our Bloomberg
great leadership.
Sorry, for our Bloomberg Television Radio audiences, we are talking, of course, with Bank of America Chairman and CEO Brian Moynihan. So let's turn to the digital side of your business because you're also seeing real growth there. Where are you on your plan, basically, to go digital? Are you 25% of the way, 50% of the way? Where are you?
Well, it's a customer by customer question. It's not an overall plan because the numbers are stunning. Almost 41 million digital customers today active, meaning they're actually using and not just they download an app or something like that. We don't count the people that have to actually do something in the last 90 days. We have Zelle users are up to 17 million. Erica users are up or Zelle's 17 million. Erica's nearly 20 million. 100 million interfaces on Erica, use it across all the business, including the wealth management businesses. These are things that just show the penetration. To give you a simple statistic, 85% of deposits of checks today are going non-physical. In other words, somebody's not handing it to a teller in the to one of our service colleagues in the branch. So it's kind of interesting. And so are we 20%, 50%, 100%? The answer is our customers keep changing their behavior. We keep moving with them, and we keep bringing out new capabilities. So life plans, which is an ability for somebody to do a financial plan for themselves. We now have 5 million users of that. 4 million did something with it in the last month or something. These are major initiatives that are taking hold, and those customers do more with us, and those life plan customers have deposit balances are 20% bigger than the non-life plan. It just goes on and on. So we're never going to be done digitizing this across all the businesses because it's just the natural transformation of society. But on the other hand, we're still a high-touch business. So we have those teammates in the branch who do a great job for our customers. We have those private bankers and Merrill teammates, and we have the relationship management commercial. So how do you have your cake and eat it too? Well, you have great capabilities and great people.
We've talked about some of the successes you've had, investment banking and other places, trading, things like that. At the same time, the costs of employing bankers, able bankers, is going up across the entire business. You've talked about it before. Where do you see that going, and where do you feel like it makes sense for Bank of America to pay up no matter what it costs, and where do you think you can be more efficient?
The question of our efficiency comes from the scale of the platform and the relationship between the business and stuff. So the highly talented people we have in all our businesses have to, they demand a great pay. Our average compensation per teammate's probably $150,000, $160,000. But we have people who make different amounts of money, but they're all highly skilled, highly capable, with great talent. We pay them, we keep them, and they develop. Now the question is, what makes us more valuable is how much leverage we can get out of that. So our middle market clients are generating 30, 40, 50% of our investment banking fees across the platform, whether it's debt underwriting, equity underwriting, and or M&A type stuff. That's where you actually drive more and more value out of the franchise, is making that person who is highly talented in any of these businesses more and more effective. And that's where the digitization also comes in terms of financial advisors, which there's a grid so-called, and that's how we pay. But on the other hand, what we're doing is they can handle more clients well, and we can use Merrill Edge and other things to handle clients automatically. That helps them handle them well, and that allows them to get more revenue. They get paid more, but the company makes more money.
Brian, throughout your tenure, you've been known as somebody really conscious about costs and holding them down. I believe you were flat year over year in non-interest costs at Bank of America. Can you keep that up, given what we've just talked about?
Well, going into the pandemic, we had around 4.5 years, if I remember right, or 3.5 years straight of operating leverage, which is our revenue grew faster than our expenses. You're comparing the first quarter of a year versus the first quarter last year. This quarter, we got back in the saddle, and what our expectation is that'll continue. Our operating leverage was 12% this quarter. So the revenue for the third quarter of 20 to 21 grew 12%, and the expenses were flat. Now, we still have expenses that we got to work out of the system because of the programs we're still supporting out there, that that PPP forgiveness, you pick it, and that's going down. But at the same time, we're investing. This year, we'll invest $3.5 trillion in technology development. Next year, we'll invest the same amount of money. We're opening up new branches in a lot of places and refurbishing a ton of branches. We're not this, we're doing buildings, we're reshuffling our real estate. All this goes on, and all that investment. Our long-term goal, stated back in 15, was once we got all this sort of excess expense out, our goal was to operate at a revenue growth rate that exceeded the GDP growth, and an expense growth that was basically the inflation level halved. And so think about 1.5 expense growth, and if the economy's growing 2 or 3%, 4 or 5% revenue growth. Across our platform, that is a huge amount of money. And sometimes it'll go faster, sometimes a little slower, but that's how we run the company. And we do that through a thing we call it operational excellence, and all the ideas to improve the company every day.
For our Bloomberg television and radio audiences, we are speaking with Bank of America Chairman and CEO Brian Moynihan. Brian, you mentioned Tom Montag about to step down. There are some other senior departures as well. You and I haven't talked since that announcement came out. Give us a sense of the timing here. Why was this the right time? And what does it say about Bank of America over the next 2, 3, 4 years?
Well, the timing is determined by people who want to make decisions, and Tom and Ann Finucane is a great colleague of Vice Chair, and Andrew Smith decided to retire, and that had a lot to do with who they are and the stage of life they're in, and so. And by the way, throughout the company and through all companies, we're making sure people are in for another big run for another decade or so, and how we drive it, and so. But the good news is they had built teams behind them. And so if you remember last year in the summer, not in the summer of 20, we moved some teammates to the management team, Jimmy and Bernie and people like that were already on the management team, Raul Anaya and Alistair Borthwick will become CFO. We moved them up to get them exposed, knowing that this type of transition would take place. And so we're largely through it now. The new people in place, Paul D'Onofrio, who's done a spectacular job as CFO for us, did his last quarter. Alistair will do the next one. Paul's going off to help drive our ESG investing and other things in the company. Ann and Tom will work through year end, and then they'll stay on our Global Advisory Council and be involved in our company. And Kathy Bassant, who will move to Europe to help us over there. So there's a series of moves, which I know people look at them and say, but these are people who've worked for our company for decades, and we're moving in a position that we have a high view, and we do this as part of our ordinary course talent planning. But at the end of the day, as a CEO, you're selfishly saying, I don't want anybody to retire, I want everybody to work, and we'll all walk out on one day and leave the place behind. That's not realistic. You've been in a position, you have to make sure that you're positioning the company for success beyond any of us, and that's what we're up to.
Brian, one last one that you'll like. Talk to us about the Boston Red Sox. You got a team still in the playoffs.
Well, they're there, and it's a lot of late nights, and 2 walk-off wins to end the last series. And that, frankly, harkens back, and I know the Yankees fans in the audience won't like this much, but the last time they did that was against the Yankees in the famous series. But look, we liked our team. It's a great bunch of teammates, and they're coming back on just what they blew the doors off early in the season and faltered a bit. Now they're coming back on, so it'll be fun, and it's good to see that. And knocking Tampa Bay out, everything, you're a Boston fan, is not a bad thing either. So
there you go. Thank you so much. Always great to talk with you. That's Bank of America Chairman and CEO Brian Moynihan. And from New York, this is Bloomberg.
All right, and of course, that's David Weston just catching up with Bank of America CEO Brian Moynihan after they reported earnings earlier today. Really one of the highlights, a bunch of headlines on the Bloomberg, but Mr. Moynihan saying that people have money to spend. Balances are up 250%, says U.S. economic growth around 5% in the next quarter.
Yeah, the company's also saying that activity level is now bigger than before the pandemic, which is a fascinating thing to hear in terms of how the company and how Moynihan is thinking about economic growth and where we are as a country right now.
Yeah, opening, where are we? How's it going? All right, David Weston with Brian Moynihan. If you missed any of it, do go to Bloomberg.com. You can listen to the entire interview. All right now, let's get back to the overall market trade and some of your top business stories. Once again, here's Charlie Pellet.
Hi, thank you very much, Carol Master. We've got 29 minutes to go ahead of the closing bell. Stocks higher. A number of headlines, important headlines from the Bloomberg Professional Service to pass along to you. Activist Jana Partners taking a stake in Macy's. This, according to the Wall Street Journal. Macy's ticker M up now by 2.9%. Icon Enterprises will start a tender for Southwest Gas for $75 a share. SWX on the ticker up now by 6.1%. FDA panel backing a Moderna booster shot for older, high-risk people. FAA taking aim at Alaska's twice the national average air accident rate. And the CFA Level 1 pass rate climbs to 26% following pandemic-era lows. Bank of America's earnings did beat projections. Fees climbed at its deal-making unit. You heard the CEO Brian Moynihan moments ago, just wrapping up that interview. He talked about a number of topics, including customer spending and what that suggests about the U.S. economy.
Almost $3 trillion of spending so far this year, and a record amount in the third quarter in our history. You're seeing that grow at double-digit rates. That is consistent with the 5% projection we have for this economy to grow this year and what the growth is seen in first half. And it's consistent with what we see next year, which is 5% plus growth in the U.S. economy.
Brian Moynihan of Bank of America shares up now by just about 4%. Some of the other stories that we're following for you: central bankers and finance ministers advising the International Monetary Fund are urging strong global cooperation to expedite vaccine access and limit what they termed a divergence in recoveries from the COVID-19 pandemic, warning that they saw risks tilting to the downside. Dr. David Dowdy is an epidemiologist at the Johns Hopkins Bloomberg School of Public Health.
2/3 or more of the world has now been vaccinated. That being said, cases worldwide are going down right now in most places, other than Eastern Europe, and so we need to get more vaccines out, because until we do, we never know when that next wave is going to hit.
Dr. Dowdy of Johns Hopkins School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine names, Pfizer up 0.7%, BioNTech, its German partner, its ADRs up 0.1%, ADRs of AstraZeneca down 0.9%, Moderna surging 3.4%, J&J Johnson & Johnson up by 0.7%. 10-year yield 1.51%, S&P up 71, up 1.6%. The Dow close to session highs right now, up 508, up 1.5%. Nasdaq up 244, up 1.7%. Spot gold up 0.3%, $17.98 the ounce. After the bell, we will be hearing from Alcoa and Duck Creek Technologies. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you, Charlie Pellet. This is Bloomberg.
Title.
One thing leads to another.
Okay.
It's not the knack.
No, but you're in the right era.
Yeah.
So, you get partial credit for that, I guess.
Not cheap trick.
No, it's not. It's a band called The Fix.
The Fix, okay.
Yes, one thing leads to another, and that seemed to be perfectly appropriate for the latest chart, because the question is whether one thing leads to another. And the one thing in this case is the decline that we're seeing in economists' projections for growth, specifically third quarter growth. And it's something that Tavis McCourt, who's an institutional equity strategist at Raymond James, focused on in his latest research. But you haven't seen the same thing pop up when it comes to earnings. Let's put some numbers around this. He looked at the Atlanta Fed GDP Now Index, which, tracks economists' forecasts. you go back to late July when the first number for the third quarter was put out, and you were looking at just above 6% growth at an annual rate. Now you're down to 1.3%. So it's clear that things have changed in a substantial way when it comes to the economic outlook. But then you go through our numbers for the S&P 500, and you see you do not have a comparable move in the earnings outlook. In fact, you've seen S&P 500 forward estimates, projections for this year go up. And we're up to about 45%. Now, it's only a 2 percentage point increase from where we were at the end of July. Thing is, though, this contrast has McCourt at least asking the question, can this go on? Now, it's possible that, economists may be in the wrong here, that they're way too pessimistic, but, so the issues that are front and center are pretty well known at this point. When you think about, supplies, the ability to get them, the price you pay for them, raw materials are part of that, labor costs are part of that. So, I thought it was an interesting study in contrast. Let's put it that way. And if you haven't seen it already, folks, send me an email. I'll get it to you along with the explanation that goes with it and everything I do going forward. The email address is dwilson@bloomberg.net. That's D as in dog, Wilson at Bloomberg.net.
And in contrast to some of the enthusiasm I feel like we're hearing from the bank CEOs, I feel like they are upbeat. You have James Gorman of Morgan Stanley talking about we need a rate hike early next year. So it's interesting. And even Brian Moynihan talking about U.S. economic growth around 5% in the next quarter. So I'm just trying to...
Right, but as we said earlier,
as
when Sonali tweeted this, she got some pushback. Oh, yeah, the executive of a bank saying that, they want to see higher interest rates, right?
Right, no, but to be able to say that speaks to optimism. So you do wonder, Dave, in terms of some of the growth estimates versus what we're seeing with earnings estimates.
Yeah, absolutely. It's just, okay, somebody's got to be right here.
That's right,
and
somebody will be, right?
The question is who, and what's the result? In other words, how do these two data series come together? And whether you're looking specifically at the third quarter or beyond, if economists are getting less optimistic and they're seeing at least some of the same things that stock analysts are, you have to figure that there's such a divergence here that, it can't go on forever.
It is pretty wild to see the divergence of the optimism that we're hearing from bank executives today and yesterday, and the way that people felt about going into this quarter. And look, I'm using terms like felt and optimism, not necessarily hard data right now. The data we'll get in the next few weeks when we start to hear more from companies. But David, it does seem like there's serious optimism, at least coming from financial services.
Well, bear in mind, for the financial services companies, right, you think about the things that business in a larger sense is dealing with. Yeah, they have labor costs. I mean, we know that, the assets walk out the door at these financial services firms, so you got to take care of them. But they're not dealing with, shipments that aren't coming out of China because the factories are closed, or they're getting delayed in transit because the port of Los Angeles or Long Beach is clogged. So it's a different, set of conditions that they're having to deal with. And so the real issue is whether, what's going on with the banks, is it all indicative of what's going to happen with the broader economy?
Stock of the day?
Really good point. No, that's a really good point. Dave, stock of the day, please.
Oh, sure. That would be AMN
Hey,
Healthcare
if you don't want to share,
Services. I certainly do. AMN Healthcare Services, the ticker AMN. We're talking home healthcare. You figure this is a company that's done pretty well during the pandemic, and you would be right. Just the other day, the share is setting a 1-year high. But now Jefferies has come out, and they actually have a buy rating on this stock, but they are turning a bit cautious. They're concerned about what's going to happen for home health care demand for temporary nurses. Because, if the Delta variant is receding, not as many people needing care at home, that becomes an issue for the company down the line. So AMN Healthcare down about 12% at the moment. And, a bit of a reversal from what the stock has seen lately, for sure.
All right, Dave, thank you so much. Dave, stock of the day, just after 4:15 p.m. Wall Street time. Find it on Facebook, LinkedIn, and on Twitter at @TheOneDave.
All right, let's get a check of the latest world and national news. Nancy Lyons is standing by in D.C. Hey, Nance.
Hey, Tim. An FDI advisory committee is endorsing Moderna booster shots for seniors and those in other high-risk groups. The panel will have a conversation about Johnson & Johnson boosters tomorrow. Well, President Biden says the number of Americans who've never received a vaccine remains too high, and he's calling on more businesses to impose mandates, even as the number of COVID-19 cases declines.
I'm calling on more businesses to step up. I'm calling on more parents to get their children vaccinated when they are eligible.
President Biden is heading into global climate talks at the end of the month in Glasgow in a weakened position, thanks to infighting among Democrats at home.
U.S. negotiators arriving in Glasgow for COP26 could show up with almost nothing to bring to the table. Congress has yet to pass a $2.5 billion down payment to help poor countries fight climate change. Lawmakers are also still debating a bill to spend hundreds of billions of dollars on renewable energy and weaning companies off fossil fuels. U.S. negotiators can point to efforts by state and local governments and businesses that take on green initiatives without federal government involvement. In Washington, I'm Amy Morris, Bloomberg Radio.
Prince William says instead of the world's richest men using their wealth to fund a new space race, he'd prefer they'd focus on this planet. The Duke of Cambridge told the BBC great minds should be trying to repair the planet, not trying to find the next place to go and live. So what were we doing during the pandemic? A new UCLA study says Americans drank and smoked more, exercised less, and logged more screen time. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. You're listening to Bloomberg Business Week. Carol Master along with Tim Stenovic in our Bloomberg Interactive Brokers studio. So this has definitely been on our radar today. We're talking about Reid Hoffman. You know him, of course, as an early Facebook investor. And he says the social network has lost people's trust for good reasons. He isn't responding well to whistleblower Frances Hauen's claims that the social media prioritizes profit over user safety. Tim, he's a partner at Greylock Partners and LinkedIn co-founder, of course.
Yeah, he spoke with Bloomberg's Emily Chang at the Goldman Sachs Builders and Innovators Summit in California. Take a listen to what he had to say.
Good for her for coming forward. Good for Facebook for doing the research. Bad for not like, well, you did the research, you discovered some things that were harmful. What are you doing about it? Right? It doesn't matter like the fact that you say, well, you know, maybe it's complicated or difficult. It's once you discover something that is really potentially very dangerous and damaging, like what we should now hear from the company is, and here's when we saw these reports, here's the stuff we started doing. Here's the way we started making trade-offs against what might otherwise be in our interest, engagement, revenue, whatever, in order to solve these problems. And that's what you want to see from companies in leadership.
So you're disappointed?
I'm disappointed.
All right, again, that was Reid Hoffman, of course, partner at Greylock Partners, LinkedIn co-founder, early Facebook investor, and he caught up with Bloomberg's Emily Chang. They were at the Goldman Sachs Builders and Innovators Summit in California. That was all over Bloomberg yesterday. I don't know.
Yeah, I mean, look, some fantastic interviews out of the conference yesterday. But it's interesting to hear, given how many years he's, you know, how early he was as an investor, his response, and also thinking about what's next for Facebook in the context of regulators, because it seems like Facebook is, no matter what problem hits it, it just keeps moving forward.
Yeah, that's for sure, right? And we know they're embroiled right now in controversy, that former employee Frances Hauen sharing thousands of pages of internal research and documents, and really shows a company struggling with content moderation. So to be continued, no doubt about it. Anyway, check out that full interview at Bloomberg.com. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pella. 13 minutes to go ahead of the closing bell with the Dow, the S&P, and NASDAQ all advancing right now. But first, these headlines. Activist Jana Partners taking a stake in Macy's. This according to the Wall Street Journal. Macy's shares up 2.9%. Icon Enterprises starting a tender offer for Southwest Gas at $75 a share. Right now, Southwest is at $68.89. Southwest Gas shares up now by 6.1%. Stocks roaring back as earnings season kicks off. We heard from the big banks this morning. Citigroup, for example, up 0.6%. Bank of America up 4.3%. You heard the CEO, Brian Moynihan, live right here on Bloomberg Business Week. Bank of America shares, as I mentioned, higher by 4%. Morgan Stanley up today by 2.4%. Wells Fargo on the minus side down 2.2%. Tomorrow morning, we will be hearing from Goldman Sachs. Goldman up now by 1%. S&P rallying 68 points, up 1.6%. The Dow up 483, up 1.4%. NASDAQ up 236, up 1.6%. 10 years up 7/32, 10-year yield 1.51%. Spot gold up 0.3%, $17.97 the ounce. And West Texas Intermediate crude up 1.2%, $81.40 a barrel. I'm Charlie Pellet. That is our Bloomberg Business Flash.
Thank you so much, Charlie Pellet. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
In the last fiscal year, the U.S. failed to issue roughly 80,000 green cards that could have been given to immigrant workers. The shortfall adds to a backlog of more than 1 million people waiting to receive employment-based visas. Congress should ensure those green cards are used and fix a system that pointlessly burdens skilled immigrants. At issue is tens of thousands of unused green cards that expired on September 30th. Legislation introduced by Republicans would authorize the government to recapture those cards, rolling them into next year. Democrats should embrace that bill, and they shouldn't stop there. Congress should also help the Immigration Service deal with staff shortages that slow green card processing. And the Biden administration should streamline the approval process. But first, lawmakers should pass the bill to keep all those expired green cards from going to waste. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
So just about 10 minutes left in today's trading session, getting ready to wrap up the Thursday trade. We are hovering near our highs, as you just heard from Charlie, just off of them, but nonetheless a rally underway. Earnings, a big reason why, and we're going to get into that economic data too. But let's break it down. Let's get to the drive to the close with Bloomberg News markets reporter Abigail Doolittle. She is on the phone in our New York City bureau. It is definitely a risk-on trade, and it's broad-based in terms of the rally.
It certainly is, Carol. We're looking at the best day for the S&P 500, as Charlie was mentioning, up 1.6% since March. The NASDAQ also up the same amount. That's the best day since May. So that's the degree of the buying power. And speaking to the broad-based nature of the rally, all 11 of the S&P 500 sectors are higher, most by about 1% or more. The best is materials, up 2.3%. That has everything to do with the rally in metals, materials, and then tech, and that has a lot to do with the fact that yields are down yet another day, relieving valuation concerns. So it's a really nice day for stocks, for sure.
Hey, Abigail, talk a little bit about the SOX, the Philadelphia Semiconductor Index, because it is having a day. At one point, higher by more than 2.4%. And at one point, there were no stocks in the SOX in the red.
You know, this is an interesting one for sure, Tim. from the standpoint that the SOX, similar to the Russell 2000, that small cap index, in recent days has been testing its 200-day moving average, something that the other indexes have not done. That's long-term support, the long-term buyers, and yet its 50-day moving average is rounding down, telling you that the near-term buyers are not around. The dip buyers are gone. But today, you have the SOX right in between. This is a range. We're seeing ranges on other indexes too, and a range is all about information or all about uncertainty. Folks are waiting for more information, and I believe that will probably gather more information on a micro level from the earnings reports. Everybody wants to know not so much about demand, but about supply, margins, the supply chains, and then of course rates. Are rates going higher or are they going lower?
And forgive me, the SOX higher by more than 2.8% as we speak.
Yes.
So wait, were you just talking about the SOX or the S&P 500?
The SOX.
The SOX with the 50-day. You said the trend line has been moving lower, correct?
Well, they're both very similar. The difference between the SOX and the S&P 500, the SOX has been in a range for much of the year, so it's been testing that 200-day moving average, whereas the S&P 500 is between the 100 and 50-day moving average. But the same idea, these range-bound trading areas where investors just don't know. The buyers don't have enough information to create new all-time highs yet, and the sellers don't feel confident enough to push these indexes lower. If the 50-day moving averages are sloping to the downside, some technicians really consider that to be an early sign of potential weakness.
Well, that's what I was going to ask you. I mean, bottom line, a healthy move that we're seeing today, reactive move. What can you tell from those technicals and the internals?
Right now, great question, Carol. It's probably a little bit more reactive until you have a break out of the range. The range is exciting in terms of these up and down moves. Each week it seems to be up and then down and then up and down and grabs a lot of attention. But the thing you really want to watch is to see which way the range breaks. And we just don't know. We're right in the middle. It's going to come down to earnings, and it will come down to inflation and rates.
It's interesting. I've got, I think, a 6-month up on the S&P 500. And for a long time, even though as we pulled back, it was like this almost steady line to the upside until we got to, what was it, like rolling over in August. And then it's really been choppy. So the one thing we know for certain is that there's more volatility in this market.
For sure. Volatility breeds volatility. And that's a terrific point on the S&P 500. That uptrend had been beautiful for such a long time.
So clean, right?
So clean. And now more holding that 50-day moving average time after time after time, telling you those dip buyers were there. But over the last 3 months, slowly but surely, the index has been rolling over a little bit. Not a lot, but it's flattening. And when you have a flattening market, it breaks the uptrend, suggesting that there's enough uncertainty that you could see some sort of a correction if the buyers really don't step in, particularly after such a huge rally. The S&P 500, like many of the other indexes, from the March lows of 2020, a double to the peak, or even more than a double. I mean, that's a pretty significant statement that you could have these indexes going up so much. So just a little bit of cooling off on, again, the micro, wondering what will these earnings reports come out, and the supply chain. There's this great chart that we've been passing around here today and yesterday.
I love when you nerds do that and you pass around a chart. I say that with love because I love charts too. Go ahead.
It's a fun thing to do. And this one's especially great. It's not even a technical analysis chart. It's showing that in the year of 2021, more than 3,000 mentions of supply chain have happened on earnings calls. And in previous years, it's much closer to 1,000. So that's the degree of the constraint coming out of the pandemic. And the big question is, what does it mean for outlooks and what does it mean for margins? That's probably the big piece of what this range in all of these indexes represents right now. Uncertainty about, are companies going to be able to continue to put up big results? Will their outlooks be strong? And then going back to the inflation and the rates question too, of course.
It is, Abigail, pretty remarkable to hear what executives from the biggest banks are saying about the economy. Brian Moynihan just now with David Weston saying that Bank of America's activity level is now bigger than before the pandemic, projects U.S. economic growth around 5% in the next quarter, that people have money to spend, balances up 250%. How is this setting the tone for what we can expect from other companies? And look, full caveat here, Dave Wilson reminding me that, these banks are not waiting for products that are on ships off the port of Long Beach and Los Angeles.
Yeah, that's an interesting point. I would certainly agree with Dave on that. And the way that I would think about it is it's very clear that all of the Fed liquidity and central bank liquidity and support out of the pandemic has certainly helped Wall Street. But will it continue to help Main Street? We just don't know. And if we continue to have these supply chain issues and labor issues, I mean, Domino's Pizza today, initially when their report came out, they missed sales, and the thought was it had to do with not as much interest in pizza because of the pandemic, pizza fatigue, basically. And
Come on.
They were like, no way.
I love my pizza.
I love pizza too. Yeah. I love white pizza, but I love Domino's cheesy bread.
Oh, learning a lot about the Chartreuse.
Yes, have a little bit of a Domino's habit, but in any case, they missed sales not because of demand, but because of labor. They didn't have enough people to take the orders and deliver the pizza.
Not good.
We see that in other sort of retail stores of all sorts.
That's a crisis. That's what I'm going to say. Hey, we got to run. Great perspective. Bloomberg News markets reporter Abigail Doolittle on the phone in our New York City bureau. All right, folks, get ready for Beyond the Bell, our cross-platform coverage with Bloomberg Radio, Bloomberg TV, and YouTube, counting you down to the closing bell on this very busy Thursday. Good breath.
And we're about 2 minutes from the end of the trading day. Romaine Bostick, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast partners, Carol Master and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences here on this Thursday afternoon. Looking at an S&P 500 up about 1.6% on the day. Strongest day that we've seen for the S&P going back to March.
Broad-based rally, big time S&P 500.
I've been telling Taylor that all day.
Just great minds think alike, Romaine. S&P at that 50-day moving average. I've been watching the stocks up almost 3%. Taiwan Semiconductor, right? Massive player in the chip space. Some upbeat news overnight, beating expectations. And so quarterly profit, we've seen the whole chip sector go up higher, guys.
Yeah, NASDAQ, best day since May. The S&P 500 basically at the same level that it was at since September 27th, or similar level there. Best day since then. Still, we're about 2.3% from the record high that we last reached on September 2nd.
Yeah, and it's interesting that, I mean, what changed? Yes, corporate earnings, pretty good. Yes, the jobless claims came in better than expected. But PPI, sure, it came in a little bit slower, but it's still incredibly elevated levels. We're still worrying about inflation, but yesterday, that's what rocked the market. Today, we look through it.
I think really interesting, Caroline. I was reading a note from Breen Economics saying that you could say that maybe the PPI was a little bit of a reprieve, but they, in their words, would think that that would be a little bit of a mistake. Headline PPI is now up 8.6% in September year over year.
Some of those year over year numbers are pretty astonishing. Some of the month over month numbers, there are a lot of negative signs on a lot of those categories, and maybe it gets to the idea of the episodic or transitory nature of some of this. That shall be seen here. Right now, let's take a look at where we stand in the markets. S&P 500 up about 1.7% right now. So a little bit of a bid here as we move to the closing bells. As always, it takes a little bit for these numbers to settle, but right now the S&P looks like it's going to be up about 74 points or so. Best day since March 5th, if that holds here. The NASDAQ Composite up about 251 points or 1.7%. Best day since May. The Dow Jones Industrial Average snapping a five-day losing streak here, up about 500 points or 1.5% here. And the Russell 2000 getting in on the action as well here. Just a correction. The Dow Jones snapping a 4-day slump. The Russell 2000 higher on the day, up about 1.4%, Carol.
Yeah, and as we said, going back to that broad base, 479 names in the S&P 500, 26 lower, none unchanged. I saw this in one of our write-throughs on the market. Corporate profits have been a boon for the equity market throughout the pandemic. Since March of 2020, though, the S&P 500 has risen each quarter, advancing 4% on average over that 6-week stretch. So, Taylor, as we move more aggressively into earnings, this could be potentially a boon for the equity markets.
Carol, if you want broad-based, I will give you broad-based. Let's take a look at this sector level as well.
Love how you think.
For our radio audience, there is a lot of green and everything is green, even in the loser section. So maybe we'll start there. The worst performers, and again, there is no red. It's up 0.6, maybe to up 1%. It's retail, it's food and beverage, it's consumer services, it's pharma. So you're getting a little hint of risk on there, and then go up to the top and it really turns around with semiconductors, transportation, materials, hardware equipment. You're up 2 to almost 3%, Carol, on all of those sectors.
Yeah, pretty impressive. And so it was hard for me to what's the matter, Romaine?
Well, I just want to point out, I mean, to Taylor's point, because she made a great point here. You got like 479 of the stocks in the S&P 500 finished in the green. That is broad-based, Taylor. But more importantly, you had something like 363 of these companies were up 1% or more here. I see you have a few of them on your screen, Carol. I'm glad no red ended up there this time.
Right.
That would have on a day like today, Carol.
All right. Oh, and the pressure here. All right, Bank of America. I got to talk about the big banks. They weren't all higher today, but Bank of America definitely an outperformer, up about 4.5%. Or David Weston talking with the CEO Brian Moynihan, the bank topping estimates thanks to a surge in M&A. We've seen that from the players in the big bank sector, up 65%. Those advisory fees to $654 million. Walgreens Boots, top in the NASDAQ 100, top in the S&P 500. They released quarterly results. That beat analyst estimates, so we saw that at play, top. They're also doubling its stake in VillageMD to 63%. They invested $5.2 billion. So all that M&A activity, these are all these companies doing deals. And then Beyond Meat, got to mention it. I'm not quite sure how you like your burger, but McDonald's. What? Yeah. I'm kind of with you too.
Taylor's our vegan. She needs give her Beyond
McPlants.
Well, you know what's crazy is that McDonald's is going to start testing this burger, and it's going to be patties from Beyond Meat. But you know what? It's going to be a burger. It's going to be mayonnaise, cheese. It's going to be booked on the same grill as meat-based products and eggs. So it's not going to be vegan.
That's not vegan.
Would you eat it, Taylor?
No.
Yeah, because my whole point is just to save the animals.
She loves animals.
Okay.
Can we just point out real quickly, Bank of America, this is phenomenal. That's the highest we've seen close we've had on Bank of America going back to 2007 here. So basically you're going back to the financial crisis. Of course, they're nowhere near the 54.90 peak that they had sort of prior to that. And of course you have Morgan Stanley rally as well. That's my interjection.
Up 49% this year.
Tim, do we have losers? Were there any losers?
We do. I'll give you the top 3 in the S&P 500, not in the order from biggest to
Wait for
lowest.
the interjection.
But let's start with Wells Fargo because it wasn't a perfect day for the big banks. The company finished the day down by more than 1.6%. It did beat on the bottom line and the top line. Expenses, though, coming in higher than anticipated. Loans at the consumer bank also dropping 14% in the quarter. Analysts were hoping they would start to see a turnaround, but they're going to have to continue to wait for that. Boeing, also among the worst performers in the S&P 500, finishing the day down close to 2%. Shares under pressure after the company found that titanium components used by one of its suppliers to the 787 Dreamliner, they weren't up to specifications for Boeing. Those are going to need to be replaced on some aircraft. This is according to a person familiar with the matter telling Bloomberg News. Caroline, the quality control around the 787 has been a huge issue for the company. They've got 100 Dreamliners parked in factories and around a desert, still waiting on U.S. regulators for a plan to inspect the aircraft for a separate structural defect. U.S. Bancorp. This is an important one. Shares taking a hit today, down by more than 2%. It did beat on the top and bottom line, but net interest income fell from the same quarter a year ago. It's among the biggest regional banks. So a mixed bag when it comes to those bank earnings today.
Let's go cross-asset. Not much of a mixed bag when you're looking across commodities, FX, bonds, stocks. A sea of green, isn't it? I seem to be matching it exactly for my radio audience. I chose my green dress, ready for the day. And we're seeing currencies, only one little bit of red. That's the Japanese yen. You're not needing a haven at the moment. And the yen has been out of favor for days now and trading near the lowest in 2-3 years. Japanese yen off by 0.4%. What wins out versus the US dollar? The Kiwi, the New Zealand dollar up more than a percentage point. The Canadian dollar, the good old loonie up 0.5%. Why? Because commodities, they drive higher. Why are we not worried about inflation today when you see the likes of Brent crude up 1.2%, WTI crude at $81 a barrel, when you see zinc, when you see tallow, metal scraps, burlap, when you see the old industrial index. Did you see that great chart on the Bloomberg? It is the oldest commodity index at that. That is at a record high. Zinc is at near record highs. We have got continued move higher in terms of commodities, but yet we see money also moving into bonds. Explain it, Taylor.
Yeah, unbelievable, Caroline. It's really interesting. So we started to see hints of this yesterday after the CPI data, and then you saw it again today with the PPI data. And a lot of this has been the curve flattening that we see. Some of this has been maybe a pull forward of rate hike expectations, Carol, and that means maybe a little bit of a slower growth, longer out on the curve. So you're seeing bonds catch a bid, price higher, yield lower by, well, 2 basis points. We migrate back down south to a 152 on the 10-year.
You know, I'm still obsessed with Caroline matching all of that green. That was pretty cool. So we talked about inflation. We talked about some of the economic news, right, guys, already. Initial jobless claims to the lowest since March of 2020. PPI, smallest advance this year. I mean, when I look at the market move, is it really that they're trading on earnings, or was it some of the economic news, or did it all kind of the perfect storm, though, in a positive way?
I asked that question to Kriti Gupta earlier on our show, and she basically said, well, look what's happened over the last month in the S&P 500. We've seen sort of this steady decline lower. So the fact is yeah, not really ignoring inflation and the concerns that we've seen, but things were ripe for a pop.
Right. But I mean, I'm going to go with the corporate profitability one. I mean, look, we started this earnings season, and the big concern here was sort of how some of these inflationary pressures were going to affect. I know we're still early into the earnings season here, but so far, what we've heard from the companies has been encouraging, not necessarily saying we're out of the woods, but it shows that a lot of them do seem to be able to manage through this and, of course, in some cases, even benefit from it.
And certainly, as we've been hearing from Sarah Malik, amongst others, Caroline is...
She's a
Newbies.
Dodgers or Giants?
Giants kind of a go.
Come on. But of course, as we've been hearing all week, investing in these companies who are able to pass on those costs. That really seems to be the theme du jour. Is it's not just value or growth. It's who can pass on some of the company on the costs and who cannot. And that might be the differentiation here.
But there's no differentiation today. Big tech run out, but so did absolutely everything else. So
well, I'm curious, what do you think is going to happen when we get the real big tech earnings? You know, sort of the big heavyweights here. You know, the Apples, Amazons. I think we get Tesla next week as well as Netflix.
Well, what's interesting is some of them, and Carol step in here, they actually have the pricing power. And that's why it hasn't been just a growth value kind of play. It's been anyone who can pass on those costs.
This is potentially where the markets start to differentiate between what are the labor-intensive areas, what are the companies, I think you made a great point about, what are the companies that no matter what can push through those price increases, and what are those companies that cannot? And if we continue to see inflation potentially at these levels, I mean, that's when maybe investors start to differentiate. We didn't talk Domino's and maybe not being able to deliver pizzas.
Well, food and alcohol was only slightly higher on PPI, so don't worry, Carol. You're good.
I'm good to know.
Yeah, 0.9%.
All right, folks, that's going to do it for our cross-platform coverage. Beyond the Bell, wrapping up on this Thursday. Join us again, same time, same place. Well, we're going to be moving around a little bit, heading to the West Coast, but nonetheless, check.
For good?
Yeah. Well, are you trying to get rid of me?
No, never.
Wow, that hurt, Romaine. That really hurt.
He's following you. He so doesn't want that to happen that he's getting on the plane
Carol,
too.
You can't get rid of me.
I thought we were on the same
I'm
page.
on the flight right behind you.
All right, we got to run, guys.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Yeah, it's a very, very busy Thursday. Lots going on, certainly in the world of business, but we had a rally underway. Right now, though, we do want to get to world and national news and Nancy Lyons.
Thanks, Carol. Former strategist for Donald Trump, Steve Bannon, did not show up today for a deposition before a House committee investigating the insurrection. So now the committee chair has set a vote for next Tuesday on whether to hold Bannon in contempt of Congress. Bannon refused to testify at former President Trump's request. Well, President Biden is urging the 66 million Americans who have not received a vaccine to go ahead and get it. Even with cases coming down, he says there's more work to do.
Now's not the time to let up. We have a lot more to do. We're in a very critical period as we work to turn the corner on COVID-19.
Biden wants more businesses to step up and require vaccines as the evidence mounts about their safety. Well, the FDA is advising the use of booster shots of the Moderna COVID-19 vaccine. Dr. Peter Marks is head of the FDA's Center for Biologics Evaluation and Research. He spoke ahead of their decision.
Mild to moderate COVID-19 can be associated with adverse outcomes such as blood clots and long COVID-19. Even in those who have breakthrough infections after vaccination.
Mark says the priority still needs to be making sure that initial vaccinations continue. Tomorrow, the FDA advisory panel will look at the evidence and consider Johnson & Johnson booster shots. Butterball is recalling ground turkey products due to possible foreign matter contamination. The company says it's recalling over 14,000 pounds of the ground turkey that may be contaminated with extraneous materials, including blue plastic. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much, Nancy Lyons. This one caught my eye when it crossed the Bloomberg earlier today. 34% return for the Harvard endowment just crossing earlier today. Yale gaining 40%. Harvard University reported returns that lagged behind its peers in the last fiscal year. Results the richest U.S. colleges attributed to, well, taking less risk.
These numbers overall, though, are pretty astonishing.
Right. 34%, right?
It was like,
come on.
Sorry, Harvard. The Massachusetts Institute of Technology's endowment returned 56%. Brown University, 52% a gain there, boosting their fund values to record levels. The value of MIT's fund soaring to $27.4 billion for the fiscal year ending June. That's an increase of $9 billion. Brown's value rose to $6.9 billion. The school's putting out some statements, emailing them today. This is a once-in-a-generation opportunity. We must use it in a way that inspires big ideas and builds a stronger MIT at a time when the world needs breakthroughs in science more than ever. That's coming from MIT's president in a statement. That's big money.
It is. We should note the S&P 500 was up 38% over the same period. So Harvard's actually trailing the S&P 500.
See, indexing.
Exactly. Trillions. Robin Wigglesworth. We talked to him yesterday.
Oh, my goodness. Harvard's endowment, though, still adding $11 billion over the 12 months. The fund's value hit a record $53 billion. In fiscal year 2020, only about a dozen colleges in the country had assets of $11 billion or more.
So what does this mean? No tuition anymore for any of these students?
Cue crickets.
Oh, yeah, okay.
Well, and this is what some
Forgiving
lawmakers have talked
loans.
about, these endowments, right, that just grow and grow and grow. And I know schools say it's expensive to run them and there's, new things being built on campuses. But we just talked a lot about inflation. And if you look at, we talk about it all the time at Bloomberg, you look at how much college tuition has gone up over pick a decade, pick 5 years. It's pretty amazing.
And how much is capital investment going to shift over the next, few decades on the other side of the pandemic? If we see a return to remote schooling, or is everyone going to be back on campus?
I think, well, yeah.
Lot to talk
Remote
about
schooling is not the same.
No, it's
not. Most people would argue. All right, you are listening to Bloomberg Radio. We're going to talk work shifting in just a moment.
And I'm Tim Stenevec. Starting Monday, Bloomberg Business Week heads to Beverly Hills for the Milken Conference.
We'll speak with some of the business world's top minds, including ARK Investment CEO Kathy Wood. That's Tuesday at 5:30 p.m.
Plus, Coma Bravo CEO Orlando Bravo and former Secretary of Transportation Elaine Chao.
Here's my pickups. We'll speak with some of the
Bloomberg World Headquarters. I'm Charlie Pellet.
We'll speak with some of the business world's top minds, including ARK Investment CEO Kathy Wood, Tuesday at 2:30 p.m.
Technology shares tumbling by 11% after our 2022.
We'll speak with some of the business world's top minds, including ARK Investment CEO Kathy Wood, today at 5:30 p.m. We'll speak with some of the business world's top minds, including ARK Investment CEO Kathy Wood, today at 2:30 p.m.
In pickups, 3, 2, 1. And I'm Tim Stenevec. Today, Bloomberg Business Week heads to Beverly Hills for the Milken Conference.
Third quarter sales coming in at
and today, we've got PGIM CEO David Hunt and BNY Mellon Wealth Management CEO Catherine
Stock market
Keating.
had its best day since March. Better than expected corporate earnings and economic reports outweighed fears that inflation pressures and supply chain snarls could crimp growth. All major groups in the S&P advanced today. The S&P up 74, up 1.7%. The Dow up 534, up 1.6%. NASDAQ up 251, up 1.7%. 10-year up 6/32, 10-year yield 1.51%. Spot gold up 0.2%, $17.96 the ounce. And West Texas Intermediate crude up 1.3%, $81.46 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Master along with Tim Stenevec in our Interactive Brokers studio. So we're hearing from a lot of the big banks this week and the CEOs, their quarterly updates. We're also continuing to hear from the CEOs at those banks about hiring and how workers are covering. In fact, it's the cover story of Business Week magazine.
It's something that we've been talking about a lot, and we're pleased to have back with us Rob Falzon, Vice Chair at Prudential Financial. He joins us once again on the phone from New Jersey. Rob, it is great to chat with you. We love talking to you about the American worker because what you do is you publish the research, the Pulse of the American Worker Survey, the grand experiment building the future of work. You found in the latest report that about 6 in 10 workers have either switched jobs during the pandemic or are actively looking for a new job. What do managers need to know about keeping their employees, retaining their employees?
Yeah, Tim, Carol, good afternoon. Yeah, stunning numbers, right? 60% of the workforce is effectively in motion when you stop to think about that. Entirely consistent, incidentally, with the JOLT report that you saw come out a couple of days ago where we had a record number of Americans that quit their jobs, 4.3 million in the month of August. So, there's the survey showing it and the actual data is reinforcing that as well. And I think what employers and leaders need to understand is why are people leaving? And I think there's through the survey, there's some things that we can absolutely identify. First, you have to, the groundwork is this disassociation with companies that employees now have. When you're working remotely for a year and a half, you lose something in terms of connection to your fellow employees and in connection to the company and its culture. And that leaves, I think, workers more open to reconsidering what their options are. And as they're doing that, they're thinking about growth opportunities. They're thinking about career changes. And they want to ensure that, while the pandemic has had negative experiences associated with it, I think, most people that we survey have actually enjoyed the flexibility of remote work, and they're looking to retain that on a go-forward basis. So they're looking to put themselves in positions that preserve that on a go-forward basis as well. So you need to think about what's motivating employees to leave, and then think about how you can actually address those objectives that they've got.
It's really interesting. I do think, Rob, that, and great to be talking with you again, how much we're trying to really figure what's going on when it comes to how people work. Just even the tension we're seeing in some of the big bank CEOs. Jane Fraser seems to be very much open to doing things much more flexibly or with flexibility. And that's not necessarily the case for some of the other big bank CEOs who have been on Wall Street for some time. Do you think things are very different going forward in terms of how we work, that it stays with us?
Yeah, absolutely, Carol. I think, there's a mindset amongst some that what we need to do is get back to 2019. And I don't think that's the issue. The issue is we need to get forward into 2022. And it's a very different talent and workplace model in 2022 than what we saw in 2019. And we have to recognize the pandemic and the economic consequences associated with that for both the bad and the good in terms of the acceleration of digital and technology adoption and the workplace flexibility that it's introduced. Those have fundamentally reshaped how people are thinking about how they engage with their employers. And it should be fundamentally reshaping how employers think about how they engage with their talent, because we can win from this. And we ought to look at it as both a proposition that wins for talent and wins for employers.
I'm thinking Tim and I are headed to, we're jumping on a plane right after this. We're headed to Stanford. We're going to do a great TV radio remote from the Stanford Graduate School of Business. But one of the things I am curious when we talk to students and the dean of the school and alumni, just the importance of when you go to apply for a job that is flexibility a priority? There's income, there's other things, but how important that is in terms of how you work. What are you hearing about as people go out and look for jobs, how important that is? Where does it kind of stack up on the list?
Well, the surveys consistently show that employees want a hybrid work environment on a go-forward basis. In any given survey, Carol, that number will bump around, but it's pretty consistently 60 to 70% of the people surveyed say, I would like a hybrid environment on a go-forward basis that has some component of remote going forward. So it's clearly a high priority. That flexibility, enables them in many, many ways, work-life balance, but, also, frankly, they can be more productive from home in undertaking certain work that they're doing. And then when they go into the office, there are things that they can accomplish there that they can't from home. So there's a desire to have the best of both worlds. And obviously, compensation is always in the mix when people are changing jobs, and you can't ignore that. Although I would note that what our surveys also show is that, it's compensation and benefits, and the benefits part of that, just given what people have experienced with the pandemic, has kind of risen in importance. But once you get past compensation, it's about how do I grow my career, how do I continue to develop, and I want to retain I want to have that, but retain flexibility with regard to my engagement with my employer.
Rob, we only have about 45 seconds left, but I want to hit on that benefits piece. So apart from compensation, tell us the benefits that employees are most interested in right now.
Well, skilling is probably at the top of that list, a non-traditional benefit, right? As they're thinking about their career development, the impediment to moving is whether they've got the skills for the jobs that are opening. So, the other statistic is we still got 10.5 million unfilled jobs.
Yeah, that's a lot.
And the reason for that is we got the skill gap that I called is now a skill canyon. And so, what I think employees value more than anything else is the ability through either, mobility within the company, so new jobs and new opportunities that they can learn from, or actual educational type stuff, skilling that will allow them to remain relevant to the workforce on a go-forward basis.
Well, we always learn so much when you join us, and it's a good gut check on what's going on in this hybrid. Is it hybrid? Is it not? Rob Falzon, be well, stay safe, Vice Chair at Prudential Financial, on the phone from New Jersey. What?
I'm just waving at people going by the studio.
I was waving at Abigail.
I know she didn't see you, but then
Thank
somebody told her to look at us and wave, and she did, and you were talking. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic in our Interactive Brokers studio. We don't have a lot of outside guests who come into the studio, but we made an exception for the next one.
We did, and we're pretty excited about it. And he comes bearing gifts.
He does. Well, I don't know if he's going to. I don't know. It might be just for show.
No pressure.
Anyway, he's an actor, award-winning actor. He's created an award-winning whiskey, involved in a lot of things, including philanthropy. So we're going to check in with Sam Hewen in just a moment. First
in the meantime, let's get to Charlie Pellet. Hey there, Charlie.
Well, hello there, and here's what's going on. We've got the Dow, the S&P, NASDAQ all pushing higher, lots of earnings, an extremely busy day in terms of news flow, but that's what we love doing here at Bloomberg. Let's begin with Alcoa, the biggest aluminum maker in the U.S. It has been enjoying such a strong rally this year that the company's finally paying a dividend to its shareholders. Company's going to pay out a 10-cent dividend on November 19th for shareholders of record as of the close of business on October 29th. Company also has announced a share repurchase program of $500 million. Shares up now by 2%. Also reporting after the closing bell, we heard from the software company Duck Creek. Its shares are lower. Its revenue forecast for 2022 lagged estimates. The stock market had its best day since March as better than estimated corporate earnings and economic reports outweighed fears that inflation pressures and supply chain snarls could crimp growth. As for the market backdrop, Bloomberg Markets reporter Abigail Doolittle was right here on Bloomberg Business Week.
The thing you really want to watch is to see which way the range breaks, and we just don't know. We're right in the middle. It's going to come down to earnings, and it will come down to inflation and rates.
And Nadia Lovell is a senior equity strategist at UBS Financial Services. She has got a 5,000 call on the S&P 500 index by the end of next year. Today, the S&P at 4438. And on Bloomberg Surveillance this morning, she was asked just how do we get there?
So financials, energy, consumer discretionary, and healthcare. We do think that healthcare will start to perform well, and that's how we're getting there. We also are looking for very healthy earnings growth, 45% this year, 10% next year, and that gets you to $5K at the end of next year.
The S&P again at 4438, up 74 points today, up 1.7%. The Dow up 534, up 1.6%. NASDAQ up 251, up 1.7%. 10-year up 7/30 seconds. 10-year yield 1.51%. Gold up 0.2%, 17.96 the ounce. West Texas Intermediate crude up 1.3%, 81.50 a barrel. So recapping, best day for the U.S. stock market since March. Better than expected corporate earnings and economic data. S&P up 1.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Got it. Thank you so much, Charlie. Well, if you follow him on social media, you'll see the many facets of our next guest. He's an award-winning actor in the widely popular streaming series Outlander, New York Times bestselling author who will be releasing a following-up book to the Times bestseller Clanlands, Whiskey, Warfare, and a Scottish Adventure Like No Other. Love the title. The new book is the Clanlands Almanac. He is engaging and fun. If you watch he and a fellow actor roam around Scotland, men in kilts. He's got some upcoming movies, a Sony film, Text for You, that's out next year. He's also got an award-winning whiskey, the Sassenach. I've tasted it. It's in the studio. It's really, really good. He's also charitable. He's My Peak Challenge, promotes a healthy lifestyle. They've raised millions for the leukemia and lymphoma charity, Bloodwise, and he's here in studio. Sam Hewen, so nice to have you here with you.
Oh, it's so nice to finally meet you in person.
We did something virtually, which was a lot of fun. We made a cocktail. I wasn't very good at it, but I did get to.
it all goes down the same way, doesn't it? And tastes great. So you did a great job.
So true. I said that we don't have a lot of people in studio. Our world is slowly coming back, and you said you haven't been in New York in a long time. How did the pandemic impact your world?
Yeah, I mean, I think, well, firstly, it's amazing to be back, and it's what great offices you have, but also in New York City, it's really buzzing, it's alive. I haven't been in the US really for the past 2 years almost, so it's so good to be back. But yeah, I mean, I think it's obviously impacted everyone, but business-wise, more more than anything, it's delayed a lot of imports and exports, especially with our whiskey.
Did it complicate things?
Oh, absolutely, yeah. I mean, I think you've maybe seen the pictures of, the container ships outside Long Beach. I think there's about 40 of them out there at the moment. Things are just really slow, globally. It's been tough. We've been challenged with the cork for our stoppers in our bottles, trying to get access to that.
Supply chain, right?
Yeah, exactly. Or just even getting a container to transport our whiskey across from the UK. So, yeah, it's been challenging.
What changes did you have to make as a result of these challenges? Did you have to raise prices? Did you have to change materials?
Or just be patient?
I think that's pretty much it. People were waiting for our next release. We released last year, and then this is our biggest release. We wanted it to be out in time for, obviously, the holiday season, but it's finally here. We were actually only delayed a couple of weeks, so we're pretty fortunate.
How much fun are you having with this? And tell us about taking it around and introducing it to people.
Yeah, so I'm really proud. Obviously, self-financed, self-realized. I designed everything, every aspect of the brand.
Self-finance, so you bootstrapped it all.
Yeah. So we haven't any investors. We've done it all ourselves, and as I said, it's our second round. We've won about 7 double gold medals from various awards. I'm just really proud of it. It's my baby.
Can you talk about why you bootstrapped it and chose not to bring on outside investors? Did you not want to dilute the equity?
I think so. Firstly, it is a small, limited batch release. It's hard to get our hands on enough of the product, so we didn't need finance at the first. But then also, just to retain the rights, to retain the majority share or control of it. And as I said, it is a passion project, so I really didn't want to give anything away. But there may be a time when we do look at finance.
Are people knocking on the door?
Yes, we have. We've definitely had conversations, and there will be a point where we want to really upscale and increase, and I think at that point investment would really help us.
Because it's interesting in the marketplace. It's a crowded marketplace, but when you can create a brand that somehow has some interesting distinction to it, and I think this one is safe to say it does also taste good, you can really move ahead. What's been the response that you're hearing? And as because you're meeting with people in New York and elsewhere.
Yeah, well, so we're now available in, I think about 40 states. We're working on the rest of them, and we're working on Canada as well, and Europe. It's a whiskey that I wanted people to be accessible. A lot of people haven't tried whiskey or don't know much about Scotch whiskey. This is a blend. There wasn't really a premium blend out there that I felt was comparable to the Asian blends out there, which are really phenomenal. So we wanted to create something like that, modern, but also with a nod to our heritage. So we've got some great malt whiskey in here, and I think people's reaction has been really, really positive.
All right, well, sit tight for a second. We got to do a little bit of news, but we're going to come back with Sam Hewen. I want to talk a little bit more about some of the projects he's involved in. Got to talk about the upcoming series of Outlander, and I know there's another new book coming, so I'm curious if they're going to go all the way.
And maybe share with us your secret about how you get all this stuff done.
What do you mean?
I
know. Yeah, because you seem like you have your hands in lots of pockets. Don't say anything yet. We're going to come back with Sam Hewen. You are listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. We're in our Interactive Brokers studio. You're listening to Bloomberg.
Let's head to Washington, D.C. for a check of the latest world and national news. Nancy Lyons is standing by. Hey, Nance.
Hey, Tim. Wages are being raised by companies as they try to fill job openings. A recent survey of chief financial officers conducted by Duke University and the Federal Reserve Banks of Richmond and Atlanta found about 6 out of 10 companies are increasing starting wages by an average of 9.8%. Nearly 3/4 of them said they're having trouble hiring. The price of gas at the pump as well as oil for heat is soaring, largely because of shortages of natural gas and coal. Bloomberg's Irv Chapman has more from Washington.
The International Energy Agency projects that the shortfall in oil will continue for months to come. The head of its oil division, Tori Bossoni, commented in a Bloomberg interview.
We're seeing really strong supply growth also in the coming months. It's not enough to meet the demand for the remainder of this year. Obviously, if it's a colder winter, we could see even stronger demand for oil. We're expecting things to improve in 2022.
Even then, Bossoni said, the need to replenish oil inventories will keep prices high for a while longer. In Washington, Irv Chapman, Bloomberg Radio.
Foreclosures are starting to surge as government and private sector programs designed to help homeowners deal with the pandemic have begun to expire. Mortgage lenders began the foreclosure process on 25,209 properties in the third quarter. That's a 32% increase from the second quarter. That's according to the mortgage data firm Atom. A booster of the Moderna COVID-19 vaccine has been endorsed by a panel of FDA advisors. It would be a half dose for seniors and others in high-risk groups. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar, Tim Stanovic, Sam Hewen still with us, of course, of Outlander fame. And we're going to continue our conversation in just a moment. But we did want to talk to you a little bit about what's it like on the set, because it looks like you guys have just an incredible group of people.
It is, yeah. We've been obviously on the show now almost, I think, about 8 years. We're in our 6th season is about to come out, and we're this sort of real core ensemble of actors, and it's been good. I mean, this was the hardest year, definitely. You know, with obviously COVID situation, but also we were shooting in winter.
Right.
It was tough. I mean, it was really difficult, but a really strong season, and I think that's what gets you through something like that. You know, your sort of friendship and your bonds, and with the crew as well. You know, it's like one big family.
What are the COVID protocols, and how is it different this season than it was in previous seasons before we were talking about COVID each and every day?
Yeah, you know, so I worked on a movie as well during COVID, a movie called Text for You. Also, Men in Kilts shows. We were one of the first shows to shoot in the UK with the COVID protocols. For Outlander, it was different and difficult because it's such a big show. You know, we have so many extras. We're out in Scotland, so it did delay us by a number of months. But the protocols, you know, everyone was tested every day. We actually had a testing center in the production offices, which was amazing. They could do a rapid test. So you get tested every morning. We had bubbles.
You did have bubbles, right? This is what we heard from when we were talking as stuff came back.
So basically different, depending on sort of your level or what your function is on set, you would then be allocated a certain bubble,
Just 20 seconds, and then we'll come back and talk some more. What I really want to know, when you drink whiskey on the set, are you drinking real whiskey?
Absolutely, of course, all the time. Yeah.
I don't believe you. Wait a minute.
Faster. Yeah.
All right, we're going to continue with Sam Hewen. We're going to talk a little bit more about whiskey. We want to hear about some of the other projects that he's working on, and I wanted to really talk to him about My Peak Challenge. I follow him on social, and it really is very inspiring in terms of what he's doing for other people. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. You are listening to Bloomberg Radio. We'll be back one moment with Sam Hewen.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Best day for the U.S. stock market since March as better than estimated corporate earnings and economic reports outweigh fears that inflation pressures and supply chain snarls could crimp growth. Today, the S&P rallied 74 points, up 1.7%. The Dow up 534, up 1.6%. Nasdaq up 251, up 1.7%. 10-year yield 1.51%. Spot gold up $3 the ounce to $17.96, up 0.2%. Crude, West Texas Intermediate crude up 1.3%, $81.50 now for a barrel of WTI. Earnings, Alcoa paying its first dividend since 2016 as aluminum soars. Shares up now by 3.2% after hours. We're also keeping an eye on the software company Duck Creek Technology. Its shares tumbling after 2022 revenue lags estimates. Shares down now by just about 11%. So again, recapping, a move higher today for the U.S. stock market. S&P up 74, up 1.7%. Best day since March. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, we're going to get back to Sam Heughan, still with us in our studio. You know him from, of course, the series Outlander. He's also, though, a New York Times bestselling author, has an award-winning whiskey, working on a lot of other projects. You and I were talking, we were talking around the table here about your brand, the Sassenach. So is there more to come? Are you going to expand this?
Yeah, you put me on the spot. Yeah, well, you know, obviously.
You could say no.
Well, absolutely. You know, our tagline is unique spirits. So we are looking, you know, around the world for, you know, unique opportunities and really just shining the spotlight on, you know, great producers and collaborating with other people. So, but, you know, obviously the whiskey is our main priority. It's our first spirit. And we really want to establish that and let that grow as well.
Are you going? Oh.
What else? Well, I'm just wondering one last one on the spirit. What else gets your attention?
We're a little obsessed
in the spirits industry right now.
Oh, I mean, there's just, you know, I mean, the explosion of tequila obviously is really interesting. I've spent a lot of time over in Tequila Town, which is a really fun place. But, you know, you even look in the UK, I mean, gin is really big. It's kind of almost overpopulated now. But yeah, I'm really interested in just like these small producers. I mean, mezcal is just fascinating, you know, and it's hard for them to upscale. So I'd love to go to Oaxaca and spend a bit of time there.
How long do you think you might hold on to the brand before maybe something, you know, we talk about people being interested, and we know certainly some of the bigger brands are always looking for new players, new entries. Do you think that the end game is that ultimately it becomes part of somebody's portfolio?
To be honest, I don't know. It's something, it's obviously very close to my heart. I poured so much of myself into this, so I want to retain it. Okay. But who knows in the future where that could go.
So let's talk about some of the other projects that you're working on. What is it like to either have a director reach out to you or a producer? Is it virtual still, or is things getting back to normal?
Yeah, it is. It is still kind of virtual. I just shot a TV show in the UK called Suspect, and that was all predominantly, you know, the read-through was done via Zoom calls, which is quite challenging, but it's great. You know, we're getting back on our feet. The movie TV industry is really, really flourishing at the moment. It's really busy.
It is really busy.
Yeah.
Well, we're seeing it certainly in and around New York too.
I mean, is it the best time to be a creative right now? You not only have streaming services just duking it out for content, for talent,
right,
but you also have established companies looking to get into streaming by creating more content. I mean, we are so hungry for content.
Yeah, we are. And I think myself, I'm already pitching something at the moment, and it has been mostly to streamers because that's where who have the money and who are making things. But I mean, it's also good to see that movie industry and people are going back to the movies. You know, I went to see Bond recently. It was fantastic. And
you mean like in the theater?
And
actually going
just
back.
that shared experience, which I think is something which we all miss as well. And I think hopefully, you know, also it will also have a life and we'll get people back into the movie theaters.
So Outlander, what can we expect in the new season?
Yeah, it's back early next year.
It's been a long dry spell.
It has. It's a different season. It's only 8 episodes. However, the episodes are longer. The first episode, I think, is an hour and a half. It's dare I say, it's Outlander, so it's quite a dark season. There's a lot going on, but I'm really excited. The first episode, especially, it's pretty strong.
It's one of the interesting things I think that you guys did, and we've had a lot of conversations about how you all come together and really portray reality. Like, you don't hide some of the difficult things that go on, whether it's in a relationship or just certainly the history that was out there, and that's pretty impressive in terms of showing it and not kind of sugarcoating things.
Yeah, I think it comes down to Diana Gabaldon's books. I think they can be pretty gritty in places. Yeah. So that's part of it. But I think also the show has tried not to shy away from certain subjects, and it can put us in a sticky situation. But I think we really do go into, trying to portray, whether it's a victim of trauma or culture, for instance, the Native Americans, which we have play a large part in our season this season.
It plays into so much kind of the world at large. If you think about the last couple of years, whether it's the pandemic or whether it's George Floyd, like things that have been in our society for such a long time, but you guys really kind of deal with that in a big way.
Yeah, but it's also showing America in its infancy, which is really interesting. I didn't know a lot of this, how this all happened, and the British influence, and it's fascinating. So it's just interesting that we're shooting, in Scotland for America, which is kind of crazy.
It is pretty cool. So, My Peak Challenge.
Yes.
Talk to us about that, because you do a lot on social about that, and you really encourage people to challenge themselves in a lot of different ways. And it could be physical or fitness, or it could be playing the guitar or gardening or whatever, right?
Yeah. Yeah, I'm still trying to play the guitar myself, but it's not getting any better. But no, it is. It's basically an online fitness program, but whilst helping yourself, you're also helping others. 50% of all the profits go to charity. We've raised just under $6 million now for our chosen charities.
It's impressive.
And it's just, to be honest, it's our peakers, as we call them. They are so inspiring. They have lost weight. They've made friends. They've found confidence. They found mobility. They share, their challenges, and it really is an amazing sort of support network that we have.
Hey, help us understand how you think about compartmentalizing different parts of your life, and just from a productivity perspective. When Carol was doing your intro, it was like the longest intro I've ever seen.
I shared.
No,
it's a lot of stuff.
Because you've done a lot of stuff, and you do a lot of stuff, and you do a lot of stuff at the same time. How do you compartmentalize it? What do you work on when? How do you keep productive?
I don't know how it happens, but I think I'm like that. I think I just wired to. I can't really sit still. Like, if I have time off, I do like to challenge myself, and I have a brilliant business partner. I think that's pretty much it, and with a great team. We have an office in Los Angeles, and I think we have about 7 members of staff now, and we're still expanding. So that's important, a good team.
How many times do you say no to things, though? And I do wonder if, like, Outlander, the Sassenach whiskey, like, there's this wonderful kind of continuity in terms of things. Do you think about that when you're choosing what you want to work on?
Yeah, absolutely. I think it's important to say no, and I'm not very good at it. But
let's all say it together. No.
But it is just as important as things you say yes to, of course. So there's obviously a lot of opportunities, not only in the business side, but also career-wise as well. I only have a short space of time when I'm not working on Outlander, so the projects I choose have to be the right ones.
All right, we're gonna have to leave it there, unfortunately. Thank you
so much for having me.
A real pleasure.
Great to see you guys.
Yeah, great to see you, and we look forward to hearing more and following you in the future. Coming up is Sound On with Joe Matthew, checking in on the day's news out of the nation's capital. Joe, what's up?
Well, I'll tell you what, we're going to be talking about a couple of different breakers today, and one of them has to do with the COVID vaccine mandates that President Biden was talking about. The politics behind this, as you well know, get to be pretty complicated, and we'll dig into that with Nick Diamond, who leads the global health practice at Kroll and Mooring International. We're also going to zero in on the Virginia governor's race with an important pollster here from Christopher Newport University. It is getting so close here, and they're calling it a bellwether for the nation. We'll see what we can learn in the state of Virginia.
You're not talking whiskey. I think we got the better deal. I'm just going to say, Joe.
How is that always the case?
I don't know. We're just born under a lucky star. Joe Matthew with Sound On coming your way in just a moment. For the whole Bloomberg Business Week team, have a good and safe evening, everyone. This is Bloomberg.
live where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Caroline Hyde in for Emily Chang. This is Bloomberg Technology, and coming up in the next hour, supply chain pain. Amazon shopping for used long-range cargo planes to move products across borders itself, while Apple cuts its iPhone 13 production by 10 million units in 2021. What this means for the consumer prices. Plus, we'll hear from Blue Origin's first ever fee-paying customers on the company's most recent flight. We'll get details on the whole experience from booking their seats to touching down. And our exclusive conversation with Clubhouse CEO Paul Davison from the Goldman Sachs Builders and Innovators Summit. Find out what he has to say about the highs, the lows of super fast growth for the social audio app. That's later this hour, but first, well, we want to get to those market moves. I mean, what a day. Kriti Gupta, Ed Ludlow with us to break it all down. And, well, some seismic moves. NASDAQ, I think, best day since May.
Absolutely. Some green on the screen, Caroline. And it wasn't just the NASDAQ. You saw that tech trade really trickle into all the subsectors. The stocks index, for example, up a whopping 3%. Even the NASDAQ biotech up 1.3%. But what was underneath? What was happening? A lot of this had to do with earnings, Caroline. People were really waiting for that chance to buy. And earnings, you had a lot of heavy hitters. United Health, Walgreens, and, of course, the big banks. So you eventually, after weeks and weeks of selling pressure, this is what you see. But let's just talk about the breadth of the rally, because you can't just have tech leading the indexes higher. And that was actually not a concern today, Caroline, because if you look at the TIC index, which really measures the advancers minus the decliners, essentially how much of the stock market is in the green, well, the highest level since all the way in March. If you go back to that level in March, that goes all the way back to June of 2020. So by those measures, Caroline, a pretty good day for the stock market. I want to show you what didn't have a good day, though, and it's those Chinese ADRs, because that tech trade, well, it stops at China, and a lot of it has to do with an article that showed up on the People's Daily, essentially what is seen as the mouthpiece by many for the Chinese government, coming out and actually saying that some of those online brokerages, those Chinese online brokerages that are listed in the U.S., well, they might be violating some of the Chinese data policies that are set to go effective on November 1st. So you see some of those ADRs that have a lot to do with that space in the red. But besides that, Caroline, a lot of green on the screen. That's what I was watching on the macro front. Let's get to the micro with Ed Ludlow.
Yeah, that kind of risk-on sentiment really carried over into cryptocurrencies as well. And I'm looking at the Bloomberg Galaxy Crypto Index, up by more than 3%, rising for a second day, highest level since May. I don't know, some bullishness returning to cryptocurrency markets. The Bloomberg Galaxy Crypto Index, of course, is largely Bitcoin, 40% in terms of weighting. But the month of October has been good, right? We've been on a bit of a tear as Bitcoin's kind of rebounded from that July low of under $30,000. We're now hovering around $58,000. So I've been tracking that. Of course, a lot of stocks on the move as well on Thursday. Particular stories that we're watching, interesting. Taiwan Semiconductor out with earnings, saying that demand is still robust for the semiconductor sector, right? They're going into the fourth quarter. Demand is so good that they say full-year sales will be up in dollar terms by 24%. Really interesting, discussed with Mr. Ives later on in the show. Uber, interesting Bloomberg scoop out of Europe. According to sources, Uber is thinking about expanding its grocery delivery footprint in Europe. They're even getting ambitious, thinking about delivery times less than 15 minutes from app to door in that grocery space. Of course, a very competitive market in Europe. And one of the laggards, you heard Kriti talk about some of those Chinese ADRs. Pinduoduo down by 3.6%. Worst decliner on the NASDAQ 100. Biggest points laggard on the NASDAQ 100 as well. Really feeling the pressure of late with that Chinese regulatory clampdown. Very finally, let's talk about Apple really quickly. Finally, rising on Thursday by more than 2%. A really big gain, but more importantly, snapping 4 straight days of declines. Its worst losing streak since June. Caroline.
A little bit of a reprieve there. We thank you both, Kriti Gupta, Ed Ludlow. Great pace. Let's keep it up now. We're going to discuss Apple that little bit more with it succumbing to supply chain woes. I want to bring in Wedbush Managing Director Dan Ives. Dan, what do you make of the snarls within the supply chain that finally hit Apple and Apple significantly? Will they be able to sustain this sort of demand even if we're having to wait that much longer for our watch for our phone?
Yeah, and I think it speaks to just the headwinds that we're seeing coming out of the Asia supply chain. The fact that Apple, in the midst of this peak iPhone 13 cycle, looks like it's going to cut 10 million, potentially 8 million units. But to us, it's more of a timing issue. I mean, demand continues to outstrip supply That's a high-class problem. Supply chain clearly an issue for Apple. But ultimately, this really means that you're going to see about 5 to 7 million units pushed from the December quarter to March. I ultimately view it as a non-event for the stock. Still think this is on a path to a much higher, what I've used a $3 trillion market cap into early next year.
So Dan, they have the loyalty that people will just suck it up. They will wait. Who doesn't have the loyalty? Who's going to lose out if they cannot get their phone, their product to you within a matter of weeks?
Well, and that speaks to a broader issue because Apple, given 97% retention rate and this super cycle playing out, it's a timing issue. But then when you look really across technology, I mean, that's why there's more worries when you look at some of their competitors.